Looking back at 2023, I'm proud of our execution. We delivered positive adjusted EBITDA and free cash flow a year ahead of schedule by focusing on operational improvements and platform revenue growth, which we grew double digits. With our platform advantages, love brand, first-party relationships with 80 million active accounts, and deep user engagement, we are well positioned to accelerate revenue growth in future years.
In Q4, we grew active accounts by 4.2 million, ending 2023 with 80 million. Full-year net adds of 10 million were above 2019 and similar to 2022 levels, driven primarily by the Roku TV program in the U.S. and international markets. We're also growing engagement on our platform, with 2023 streaming hours up 18.6 billion year over year to a record 106 billion hours. Average streaming hours per active account per day were 4.1 hours in Q4 2023, up from 3.8 hours in Q4 2022 and 3.6 hours in Q4 2021. Devices revenue increased 15% year over year in Q4, driven by Roku branded TVs, which launched in March 2023. While we remain mindful of the challenging macro environment and uneven ad market recovery, we plan to increase revenue and free cash flow and achieve profitability over time. Turning to OpEx, we anticipate Q1 year-over-year growth rate to negative low to mid-teens, a significant improvement from OpEx year-over-year growth of approximately 40% in Q1 23.
We continue to see actually a really solid rebound in video advertising in fourth quarter. I'm really pleased with the way video advertising has strengthened in general, offsetting what has been and remains a challenging M&E marketplace. Political is growing for us. It's our tools and our tech make Roku a strategic platform for political advertising. I will point out that in 24, we expect political to grow, but it'll likely remain a relatively small contributor as a percentage of our whole really diverse ad business. We know political obviously is a big opportunity and a big market. We have some product updates that'll help us tap into these budgets more and more in the future. We're making those updates to our platform as well as other refinements that we'll make moving forward. So overall, we expect political to grow over time. For now, it'll grow, but it'll remain a relatively modest part of the overall ad mix at Roku.
And I know there's been a lot of talk today about my beloved Roku City and all things food and some of those integrations. What's remarkable about these integrations is that they're also scarce. So we look at what scarcity does to drive pricing. And Anthony's last answer about the opportunities that we see, not just on the home screen, but throughout the entire streamer's journey. So many of the sponsorships that, as we said, used to be M&E only are now both M&E and non-endemic advertisers. And what's terrific about that, not only does it open up that scarcity to new bidding and new advertisers, but it's also driving pricing.
I assume you're referring to the article in the Wall Street Journal. I mean, we obviously can't comment on that. That's a rumor, but I'll just say a few comments in general. First of all, we're the industry leader with 80 million active accounts and growing. And one of the primary reasons that we're the leader in streaming platforms is that viewers love our products. They love our brand. We have strong retail relationships. We have a great relationship with Walmart. We have a great relationships with lots of retailers. And we have strong distribution both inside and outside the United States. Our lower hardware costs, we have lower hardware costs than any other TV manufacturer that I'm aware of. And all of this gives me a lot of confidence that we're going to keep growing our distribution. We added 10 million net active accounts last year, and we're going to add a lot more active accounts this year as well. Like we said, it was pressured. It will continue to be pressured for a while. But despite that, our platform revenue grew 13%. And then in Q4, the year-over-year growth rate of video ads on our platform outperformed both the streaming industry overall as well as obviously the traditional TV industry. I mean, what's going on with M&E is pretty straightforward. And they spent a lot of money on M&E in the go-go years of the COVID pandemic. Now that they're retrenching and focusing on a sustainable business, that spending is normalized down a little bit. But it's going to continue to pick back up, and over time, it will be a growth business for us.
So again, we see tremendous opportunity to monetize our platform. We're really just getting started. We're doing a good job. 2023 was very strong, but there's a lot of opportunity as we've grown to these 80 million actives. But when we think about it, again, it's not, we don't focus so much on a margin percent or an EBITDA. We're focused on absolute free cash flow and free cash flow per share and driving that up over time.